It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners right here at Korhorn Financial Group. With me in the KFG studios, Kevin Korhorn and Josh Gregory.
Hey, what's the best way to invest? You ever think about that? What strategies should you be using? What specific investments should you be using? Maybe this year you're thinking, how do you handle the kind of volatility that we've seen so far this calendar year? We're covering these foundational and pivotal questions on this episode of Wise Money.
That's right. We get a lot of questions about what is going on right now. Got a lot of questions last week about the PPP loan and the changes, the enhancements, and all sorts of things like that. So reach out to us. We love hearing from you and getting your questions. You can find us online, wisemoneyshow.com. Submit a question right there. And then all over social media. That's where we get most questions. So you'll find us wherever you're at, whether that's YouTube or Facebook or Twitter, whatever. Just search the Wise Money Show or at Wise Money Show and submit questions that way. You can always call or text as well, 574-222-2000. That's 574-222-2000. All right, so we are talking about foundational investment principles. How should you invest? What's the right strategy? But there's no way you can talk about that without talking about, hey, what sort of strategy has navigated this craziness in 2020? So, guys, what do you make of what's happened in 2020 in the markets and how investors should be behaving or should structure their investments?
I like your question, Mike. What are the guiding principles that I should follow? So what I would encourage you to do, if it's at all possible, set up your investments to happen systematically, to set it and forget it. Because if you look at the number of things that we could be thinking about right now, like what am I focused on? Am I focused on the rioting and looting or police brutality or a trade war in China? Or, oh, by the way, there's this little global pandemic that's happening. Like, what else should I be thinking about? And I would encourage you, if it's at all possible, set up your investments so you don't have to think about them. So if you're in accumulation phase, set it up so that that's happening systematically. And if you're in the decumulation phase, set it up so that that's happening systematically as well. And you're not concerned on any given day where the market is, because it's truly unknowable. And if you fixate on the market, it will just be one more thing that's added to the list that I already mentioned of things that are completely outside of your control. That on a day when the market goes up, I have the illusion of being in control and feeling like I know what I'm doing. And on a day when the market goes down, I am depressed. And so don't let the market, and I would encourage you to understand the internal finance piece. Don't let the market be your source of happiness. I mean, if you're going to, like if you live in Michiana, let the sun be your source of happiness.
Yeah.
Okay, stop. I'm sorry.
Bad idea there, too.
Bad idea.
Now, that might sound like crazy talk to some people because they're used to looking at their investments every single day. And during this crisis, maybe they've gone to looking at their investments every single hour. It's like overwhelming them, and they've gone from a stressful picture that they see of the future to one that's maybe completely overwhelming. And that's really what a market crisis brings to the situation. It's either going to bring a source of panic for you. It could be a source of stress. It could be damaging to you because you take the wrong action during that time. Or for others, it's an opportunity. And still others, it's just part of the roller coaster ride that they're on, looking to a very bright future because they have an overall game plan. And these short-term periods, whether they're up or down, don't really matter in the grand scheme of things.
Okay, so what do you make of what we've seen thus far in 2020? I agree with everything you guys have said. Lots of thoughts running through my head, but I'll just respond with another question. This is apparently a global crisis. Obviously, the pandemic is, but then the financial response from the central banks and this is going to what is it? The budgeting office came out last week and said it's going to take over 10 years to recoup the amount of cost in the United States that is going on right now, and yet it's taken 2 months for the stock market to come back. And so should investors say, yep, this is normal. These crises last about 2 months, and they come right back. Is this normal?
It just takes me back to the football game. Who was playing New England? The Falcons? Was it the Falcons playing
Atlanta,
New England? Yeah, like at the halftime, we said, hey, let's just shut it off. Like New England has been snuffed out sufficiently, like just turn it off and ignore it. If you look at the stock market, which seems to be climbing this mountain of cash that the Fed has pumped into it, I look at the valuations and I look at some of these other things, and the only thing that it reminds me is it doesn't make any sense.
Well, let me jump on that. This is one of the things that I've found confusing. So I completely agree that if you look at your investments too frequently and they are your source of joy or disappointment, then you've got your finances oriented incorrectly. Okay,
Yeah.
but get this. 2 weeks ago, did you see this headline in the report that said Zoom, this online video communication software, is worth more than the 7 largest airlines combined? Okay, did you hear this? And I saw the chart. That was 2 weeks ago. Last week, so it was 49 billion, and it showed this chart. Okay, Zoom is worth 49 billion, and then Southwest is worth this much, and Delta's worth this, and if you add it all up, Zoom is now equal more than that. But 1 week later, Zoom wasn't worth 49 billion. It was worth $69 billion.
Wow.
1 week later. That is crazy for pretty much FaceTime, which comes free with your phone. And they just decided to put it in a better platform to do it with more than one person. And there's essentially 0 barriers to entry here. And this company exploded $20 billion in a week and is worth more than the 7 largest airlines plus now. That's crazy.
That's right. Well, and that's part of the problem. It's what people look at when they see the Fed, pumping so much money into the economy. There's a lot of stimulus happening right now that's creating kind of an artificial environment that maybe isn't sustainable long term. Although maybe they're just dealing with a crisis, and the market right now is priced as though the economy is going to rebound relatively quickly. I just saw a report that said China by the end of this year will be back to the glide path that they had been on, the trajectory that they were before. And it's just hard to believe because there's still so many people who are negatively affected by this. There's industries, there's businesses that are shutting down. And it's hard to reconcile a rising stock market with a real life economy that still feels just so shaken up and broken.
But that always happens that way. The stock market always moves before the economy does. So it is always the case that you're going to see unemployment really high and potentially still rising as the tide turns in the market. But what you also always see during these great financial crises is you see investors say, I'm done with stocks for good. And we've seen the exact opposite. In fact, the rebound, the decline was so swift and the rebound was so swift that investors are hungry for more. They want more. And this is very, very atypical. So how do you structure your investments? What's ahead for the rest of the year in the market? We've got a lot more to hit here on Wise Money with Korhorn Financial Group. Do we need to change this video? I don't know how I'm sitting. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. My name is Mike Bernard. Here with me, Kevin Korhorn, Josh Gregory. If you're new to the channel, hit that subscribe button, turn on notifications, smash that thumbs up button. If you like the content, you found anything helpful, maybe even humorous, please smash that like button. We appreciate it. What you're watching right now is our full 1-hour radio show that airs on a couple stations in northern Indiana. But then also throughout the week, we're sharing smaller nuggets, next wise steps that you should be doing with your finances, and then an e-learning course on financial foundation. So make sure you subscribe to this channel and, again, share the content. Thank you very much. So did you see, were you looking that article up?
No, I was.
The one about Zoom?
Yeah.
No, I was looking up. I mean, have you guys followed the story about the other Zoom?
No.
There's 2 Zooms. So the other Zoom went like this and then like this.
That's unbelievable.
I know. So there's Zoom Info Technologies and Zoom Video Communications.
Why does that make me laugh? So
Because it's stinking funny. I mean, funny, not funny if you're investing in the wrong Zoom, I guess.
So check this out. Boom. Right? Okay. So then let's look at the date of that article. May 15. Okay. 49 billion. Let me pull up.
Dude, the article I'm looking at says Zoom is worth $30 billion.
That's the wrong Zoom.
Date.
No, it's the right Zoom, just a different date.
Yeah, exactly. Market cap of Zoom Video Technology.
The number of the airlines have permission now to stop flying to certain markets.
Yeah, I saw that.
Yeah.
Like
So-
a lot of markets.
Yeah.
Makes you wonder some of these local economies, what that's going to do to them.
No, we're back to hitchhiking, Josh.
You just got to jump a train.
Hey, my
You know,
favorite.
my father-in-law did that when he was like younger.
Shouldn't that be on all of our bucket lists?
Yes.
I mean, when we were growing up, we were reading the Hardy Boys and those sorts of things, and Huck Finn and all. I mean, the adventure is some, ripped up jeans or cut off jean shorts and jumping on a train and seeing where it takes you.
I always wanted to do that, especially in college, because there were a number of train tracks that went past the house that we lived in. And so with Carlton Kincaid, my All-American wrestling roommate who went to Central Michigan University. But I said, Carlton, let's just hop on. And when it stops in Lansing, we'll get off, go find a payphone, call our roommates, and have them come get us. And I couldn't ever get the buy-in that would have been necessary to pull off a stunt like that. Yeah. So, but everyone kind of wants to channel their inner hobo,
Yeah.
right?
All right. So for those of you on YouTube, obviously the YouTube platform is it's more conducive for bite-sized chunks. So if you didn't check out, what is going on with this? We're frozen
He
here.
broke it.
Oh, it's connected to Comcast, and they're having a few problems.
Okay, so if you didn't check it out, it's a stock market bubble was the video. It's probably the only one out there on YouTube called Stock Market Bubble. No, there's a gazillion. There's a gazillion of those, but ours we weren't pandering. It was just valuations. We're going to talk about it on this upcoming segment. Valuations. Now, I told Kevin, haven't been at this level since 2001. Early 2001 and 2000. The Buffett indicator, which is basically, the market cap compared to GDP, because GDP is economic activity. I know there's flaws in it. So GNP, or is it just flawed anyway? But the market, size of the market connected to what's actually the economic activity. And it hasn't been this high since 1999. So basically, valuations are astronomical. And it's almost the point of the video, which is why I would tell you to watch it if you haven't, is the stock market right now is saying it doesn't matter. In 12 months, everything's going to be fine. Don't look at these valuations today. Don't look at profits today. It doesn't matter. Everything's going to be fine in a few months or in a year. And that's exactly what was said during the tech bubble. Don't look at this stuff. Don't look at the valuations today. Don't look at the PE of Zoom being over 1,000. It doesn't matter. They'll make money in the future, so buy it today. And maybe they'll be right this time. I just have my doubts. And when you combine that with the fact that the market never got cheap and investors never said, I'm done with this thing, it just makes me really skeptical. Hopefully we're back to new highs and everything's fine. It just means we never did get the bear market and the economic crisis, that the healthy, freaky economic crisis that is supposed to come. So we're still waiting. The bull market that started in 2009 rages on. That's my conclusion.
Interesting.
We never saw what was supposed to happen.
Yeah, I mean, I've looked at. Well, are we going to get into this in?
Sure,
in
we can. I don't even know what to say though.
Yeah.
We'll just keep.
We'll just all kind of,
Yeah.
Is that good radio if we're just all,
Boy, this is weird. Okay. What do valuations say about the size of the stock market and really the level at which it's run back to? Should you be fearful? Should you be opportunistic? Should you buy into this FOMO rally? Or should you have guiding principles in your investment structure that lead you to really not buy into head fakes or panic when things are down? That's what we're talking about today. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. To stay up to date on all Wise Money content, you'll find us everywhere you're at on social media, except for Snapchat. Just search
TikTok.
Yep, just not on TikTok either. Just search Wise Money Show wherever you're at. Subscribe to the content there and submit questions there as well. And you'll also find us online, wisemoneyshow.com. All right, so we're talking about the current levels of the market and what's been going on in 2020, but we're tying it back not just to speculation about why and then what's to come, but tying it back to what's your overall investment strategy and what's the right investment approach for you. But I think there's a little more banter here on valuations. I did a video, one of our Next Wise Step videos, I think it was Tuesday, 2 weeks ago, week and a half ago, that there are, if you look at valuations, which is basically the price of the market, price of a stock compared to the recent earnings or the projected earnings, the market hasn't been this high since, from a valuation standpoint, since the tech bubble. Mm-hmm. And it's sort of on the belief, I believe, that, well, listen, what happens in the short term with profit doesn't matter because this is just a temporary crisis. Things will get back to normal in 12 months or 18 months. But I don't know. I have my doubts. I mean, that's the same thing that was said during the tech bubble. These companies don't need to have profit today because they're going to have profit in the future. Don't worry about things today. And we got burned. Not we, but as investors, we got burned. We're setting ourselves up for that again.
Well, you're exactly right. I mean, I like to track valuations based on forward price earnings, as you were referring to, basically saying, based on the profits we think are coming, is the stock market a good buy right now? And as you said, highest it's been in the past 18 years, I think.
Yeah, and not only that, it never even got cheap. Like if you watch that video on YouTube and you look at the chart that we flash up there, you'll see the little caret, the little drop down, but it never even approached reasonableness levels, even at the bottom in March.
Yeah, and that's something that we looked at back in the financial crisis, 2008, 2009. You're looking for some sort of bottoming out, essentially, on the price is getting so low that it just doesn't even make sense for the stock market to be this cheap. And that's what attracts buyers in to really start pushing the market higher. We had buyers attracted in March and April this year, and that's causing the stock market to have a sharp rally. But is this just kind of some short-term buying activity, and many of these buyers are going to turn into sellers before too long? Nobody knows.
No one knows.
Lots of people will make their predictions, but nobody really knows. And that's part of the reason why what happens in the short term cannot be what drives your overall financial plan. Your goals are long-term goals. If you're investing, it's because you've got money that you can put at risk for a long time, not just a short term. And that's important because it takes a long time to reach your most important goals. And the stock market is the only tool that historically has been able to give people the potential to achieve great results for their future over time.
And it's not done yet, but this is, again, why we want to have guiding principles that we operate by, because we watched Warren Buffett push 8 billion, billion with a B, 8,000 millions into airline stocks. We watched him retrieve 4 billion. So the smartest, one of the best investors of all time, lost 50%, because you only lose it when you recognize the loss. Now, as of this moment in hindsight, he looks like he made a pretty meaningful mistake. But again, it's not over. And the question is, do you have the time to attend to investments and what's happening with airline stocks and what's happening with energy stocks and what's happening with real estate and consumer cycle, all that stuff? I'm going to go out on a limb and say you probably don't. You probably want to be at Lake Michigan this summer, or what's left of it. And
but can you really know? Can you, even if you
no,
had
it's not
the time?
knowable. It's not. You can have the illusion of knowing, and you can kid yourself into thinking, "Hey, I really have this thing figured out." But I'm going to tell you, Warren Buffett thought he really had this thing figured out. And he was a willing seller at 4 billion. There were willing buyers out there at 4 billion. Warren Buffett was saying, "I'm getting out," and there were people saying, "Hey, I'm getting in at 4 billion. I think that's a good deal."
Yeah,
It's a bet though, one way or another, and historically, everyone always judges Warren Buffett's moves shortly after he's made them, and inevitably, you look back on history, he's usually right.
yeah.
So, you were making reference, Mike, to one of the Buffett indicators that often people are tracking and trying to kind of reference where are we compared to history as far as the stock market's value compared to the economy, right? I don't know if you want to unpack that at all, but this is one of his own methodologies to determine, hey, is now a good time to buy or not? And, someone like Warren Buffett attracts a lot of attention. When he's buying, it gets people's attention. When he's not buying, it gets people's attention.
Yeah.
And that's been more of the posture. There haven't been any really big deals that he's been doing. And it kind of leads you to wonder, is that because he thinks that maybe there's more pain to come? The point in all this, though, is are you going to be able to outthink Warren Buffett? Are you going to be able to predict exactly where the economy is going and each individual stock in it? And if you're not, then probably the tool for you to be using is not picking individual stocks to grow for the future. It's maybe something more like mutual funds, where you entrust those dollars to a professional to do it for you.
That's more important than what I'm about to say. But my goodness, Josh, why did you do this? So here's the deal. The Buffett indicator, this is made popular by Warren Buffett. Can you believe that?
Wow.
He's named it. Okay, so in September 2001 or in 2001, he came out and said the ratio of the overall market, corporate market cap, as a ratio compared to the overall economic activity, GDP, that's the single best indicator of the current value of the market. And he's a value investor. So, and I'm paraphrasing here, but that's how strongly he believes in this. And there's a guru focus website that just has put the formula in there, and they're constantly updating it. So I'm going to tell you, as of today, and I don't know what day you're absorbing this content, but as of today, if you go to that site, it says significantly overvalued. Based on the historical ratio, we're likely to see a negative return. That includes dividends. But it says here that's with the latest GDP numbers. What's going to happen to GDP in a month when we get that information? Well, there's certain Federal Reserve banks that say GDP is about to drop 50%. So what's going to happen with this ratio? You know how ratios work? When that number when the GDP drops like that, if the stock market's anywhere close to where it is right now, this Buffett indicator is going to reach levels that we've never, ever seen. And we might look back, I hope we do, and say this was just a blip. It was a pandemic. This was, and because of the united front that central banks made of printing a bunch and pumping a bunch of money into the system, this was a blip. It was fine. We actually don't even need to look at this data during this time period. but we'll see. I don't know. We are going to bring this back down to what should your investment strategy be? Tangible takeaways, that and more coming up here on the Wise Money Show with Korhorn Financial Group. It's unbelievable. This is unbelievable. So, I know we're premiering this video, but it was pre-recorded because at the time we're recording this, it says significantly overvalued based on the historic ratio. It's likely to return negative 1.9% a year. That includes dividends. So basically, negative 4 to 5%. And I want you to know,
Over what period into the future, though?
Doesn't say. You think it would, but average annualized return of negative 1.9%. I want you to know, when I was doing the research for this valuation video last week, and when I looked at this, it said it was going to be negative 0.9%. That's how quickly the market has bounced. And I truly do hope there's nothing more important to your financial life than being a long-term owner of the greatest enterprises on the planet. I mean, that is it. Starting to save and making sure you're investing in strong, basically in the market. I mean, that is, the folks that do that young and early, I mean, they're just in a much better position.
Right.
But we're just saying in the short term, this has been quite a bizarre setup here.
It's not like you have anything to look back on in history, though, to truly compare it to.
That's exactly right.
Because we turned the economy off.
Exactly.
We just flipped a switch, shut her down, and nobody really knows how it's gonna rebound, because there will be some who don't get to open back up, right? They are shut down permanently. Mm-hmm. And it might be your favorite restaurant down the street. It might be your favorite rental car company or your favorite clothing store. Who knows?
Yeah.
But the point is, we've truly never seen this before. That doesn't mean, though, that this meltdown is going to continue and you can't trust economic principles and business principles to eventually prevail. Capitalism still exists, right? And I don't know. I love what you just said about how important it is to own the greatest companies on the planet and to benefit when they're making money, when they're profitable, because they're bringing great services, great products that still are needed by society. And I don't know, these business owners, they know how to go out and succeed. Ultimately. So
did you hear the rumor, or at least the suggestion, that Amazon buy a bunch of these mall corners, that are vacant from JCPenney's, and basically have a warehouse distribution right there?
Yeah.
And on the main level, have it where you can come in and try out the Amazon basic products. Because that's one of the problems. You can't touch these products before you buy them. You can't try on the clothes, whatever. I bet they could buy it cheap. And everyone's already hooked to the juice. I mean, Amazon, you look at what Target and Walmart do online, and it's laughable compared to what Amazon does online.
Sure.
So, I mean, if they could buy that at a steal, that could make a lot of sense for them. I don't know.
Shh. I was going to go try and buy it myself.
And then lease it to Amazon. Good idea. Good idea, Simon. It wouldn't surprise me if Simon Malls had a whole bunch of Amazons in the corner.
What I'm going to do is go and buy a bunch of these malls, put movie theaters in them.
Yeah.
Okay, here we go.
I miss going to the movies.
I know.
I'm ready.
Okay, let's go. Okay.
All right. This is third segment. So let's distill all of this. What do you do then? Do you get in, get out? Do you just ignore it? What do you do? It's have principles, have it connected to your overall financial plan. So
okay,
let's roll. with all the craziness that has gone on in the market and is certainly ahead of us as well, how do you invest? What is the right strategy for you? And how is that connected to the rest of your financial life? We're getting to the root of it right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on our YouTube channel. Check us out there. Go to YouTube, search Wise Money Show, and subscribe to it as well, because not only is every episode of the Wise Money Show there, but all of the financial nuggets every single business day. We drop a Next Wise Step video talking about more palatable, more direct. These are some financial steps you need to be taking in light of what is going on. So make sure you check that out there. We also just dropped our e-learning course on financial foundation. So check it out. Go to YouTube, search the Wise Money Show, follow us there. All right. Listen, I'm just going to say it on the airwaves. Typically a drop of this magnitude with the financial or with the economic carnage that we're seeing, people get to the point where they say, I'm done investing, period. In the 70s it happened, and the 2000s it happened, 2008 it happened. I mean, that's what typically happens. That did not happen here. So we're skeptical, and we think there's more volatility ahead. There's more, hopefully not, but who knows? But does that matter? Does that matter? Should this mean, well, don't have any money in stocks, keep it all in your mattress, or have it all in stocks, in fact, buy airlines? Or what? I mean, how do you drive this down to your investment strategy?
Well, I would encourage you to just have an investment strategy. Mm-hmm. I would encourage you to not try and figure this stuff out, because the smartest guys in the world get it wrong. And to Josh's point earlier, depending on when you look at it, it's either right or wrong. And the longer time goes, things either get righter or wronger. And it just really depends on what's happened. So if you're doing this, from our perspective, from the Wise Money Show, we're following guiding principles, and that means I'm looking at investment planning, and there are a lot of decisions that need to be made in the area of investment planning. One is what are the investment vehicles that I have access to? And then what the next thing that needs to happen is, okay, within those investment vehicles, how should I structure my investments? We like to have a couple of different approaches. One approach is a buy and hold approach. And so it's just, hey, listen, that buy and hold approach, this year you would have seen it maybe up 5%, down 30%. And depending on the day that you're listening to this, you could be, flat on the year. So we've seen all kinds of incredible volatility. If you buy and hold, you just strap yourself into the roller coaster and go along for the ride. Over the long term, that's a fantastic strategy. And over the long term, it's likely you'll be happiest with that one. Yep. We also have an advance and protect strategy that has a sell discipline, that looks at momentum, that, for instance, when transportation stocks are out of favor, it doesn't own them. When energy stocks are out of favor, we're not invested in those. Now you say, well, wait a minute, what about an S&P 500 index? You own the index, you own those stocks. Mm-hmm. And so I like both of those strategies, but I wouldn't ignore the tax implications of the investment vehicles and the strategies that I'm using. This is why financial planning is so important. So, I mean, you could just work your way right around the circle here, figuring out financial planning. How does this affect me? Because really, my investment manager needs to be talking to my tax planner, not my tax preparer, my tax planner. And do I have a plan that's working? And also, I mean, that gets me all the way around to my present financial position. In my budget, how much do I have on a weekly or monthly basis to be adding if I need to add, or to be subtracting if I'm pulling money out?
Yeah. I'm glad that you turn the attention from just investment decision making and maybe even speculation to having an overall game plan in your life, because ultimately the value of making your investment decisions within the context of your financial plan is it helps protect against emotional responses. Mm-hmm. And that's really what you have to guard against, especially in an environment like this. In fact, I would encourage you, when you think of your financial life or specifically your investment portfolio, what are the emotions that are going on inside you right now? There are some who are scared or feeling worried that maybe they're missing out on an amazing run because you're hearing stories of people who bought a stock down at the bottom of the market and they've doubled their money in 2 months or tripled their money in 2 months. And you hear enough of those stories and you think, man, I'm losing out here. Why am I not buying some individual stocks? I better scrape together some money, and boy, we're going on a buying spree.
Yeah.
And there's still other people who are the exact opposite, who maybe are fearful that not only is there more pain ahead, but there's unrecoverable pain ahead, and I need to be, running for the hills, staying completely out of the market entirely.
And you know what? Josh, it sounds like he's talking about two different people. That's the same person.
That's right.
Just depending on the day.
That's exactly right. That's exactly right. The whole idea here, though, is that when you make your investment decisions that are tied to some time frame and some specific goal, then it becomes more apparent to you what is the funding tool that is most appropriate. Do you need to be tied to the stock market with some portion of this money because you need growth potential? You need to be able to stay out ahead of inflation. You have, big needs in the future, and therefore you need big dollars in the future.
Yeah.
When you need that kind of growth, to abandon the stock market in the short term or permanently could be one of the worst mistakes that you ever make. And I'm saying that not knowing what the market's going to do the rest of this summer or into the fall. It doesn't matter, because ultimately we're talking about a goal that could be 10, 15, 20 years down the road, and that's when it's going to matter.
That's right.
And that's the area that I didn't really get into, which is either retirement planning or education planning. What is the purpose of these dollars, and what kind of expectations do I assign to these dollars as they're invested? Because the expectation that I assign to these dollars as far as what they're going to return and how they're going to grow for me tells me how many dollars I need to set aside. I would encourage you, if you're saving for retirement right now and you don't know what the mortgage payment for your retirement is, you need to be talking to a financial planner and say, how much should I be saving for my retirement?
Yeah, what's my 30-year payment here? What's my 40-year payment in order to get this job done? And just like a mortgage payment where there's an interest rate that it's a charge, baked into that calculation from your certified financial planner is an interest rate at which you should average in a return in order to get that done. And if you say, hey, I'm probably going to bail out of stocks, then that interest rate's going to be zero. And therefore, that mortgage payment is going to go up significantly.
Hearing you guys talk about education goals and retirement goals, my mind went somewhere differently, and that was those who are sending kids off to college in a year or in a matter of weeks, maybe. Whatever is happening here in the short term, if you're getting close to this goal, my hope is that you've been making adjustments to your portfolio along the way. Maybe you missed an opportunity. You should have been out of the stock market a while ago. Well, you've been given a gift here.
Yeah.
You've been given another window of opportunity to get some dollars out if the timing is right for an exit because of your goal, not because of some prediction you're making on the stock market.
Principle-based. And so your investment strategy, your investment structure needs to be connected to all 6 areas of your financial life. It's one of them, needs to be connected to the other 5. And then we believe out of that, typically you need a multi-strategy approach, a core, low-cost buy and hold approach with a momentum strategy. Kevin didn't even talk about the performance of the momentum strategy this year. It's been phenomenal, but you need to have a balance between those two. So, all right, we've got questions from fans of the show, that and more coming up here on the Wise Money Show with Korhorn Financial Group. Did I leave enough pause in there for you to? Okay, I don't know. Anyway. Yeah. So we can share it on YouTube. I don't know. My fear. I remember drawing on this on the board back in. It was February. I know. Our momentum strategy got out very, very, very quickly. Transitioned out of what had momentum into cash because there was nothing that was gaining momentum. And I remember telling Kevin for sure, I don't know, Josh, if you were in there, but my fear was we were going to get this huge rebound as we started getting good news, just enough for our dynamic strategy, because it's momentum-based. Anyone who tells you there's an investment solution out there that can anticipate a top and a bottom, they're lying. That's not possible. That is called gambling. There's lots of people that gamble in the markets, but that's not investing. That's not possible. So on a following a momentum system, you get a confirmed momentum swing on the upside, the system's going to get back in, which ours has completely. Mm-hmm. And I remember saying, my concern is that we avoided so much of the down. We jump in on the way back up just for it to drop again. And how quickly will our momentum strategy get out? I don't know. No one knows. But our momentum strategy was completely out of the market by March 1. And started getting back in the market mid-April. This performed phenomenally.
Mm-hmm. Well, it's fun to see people who, we have some clients who we only provide to them their momentum strategy that you're describing because all of their buy and hold type money is in their retirement plan at work, for example. And so you can just purely watch how their roller coaster ride has been and see that they're into positive territory for the year. And if you would have asked me, hey, what's the market going to look like, early to mid-June of 2020 after what we were living through in March, I would not have predicted the overall market doing what it's done or dynamic investments already being positive. So
no way. All right, so let's start with Jim's question here, and I got a similar question from a client that's just the exact opposite. So we might hit Jim's question, then depending on that conversation, I might give you part 2, and we'll talk about it. So 13.
How do you plan for retirement?
How does the coronavirus and all the changes going on with businesses and work environments, how does that impact you if you're right on the verge of retirement? Got a great question from a fan of the show, Jim, where we're going to be hitting that very thing. This is the Wise Money Show with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every single morning, I'm getting up and going for a walk because where we live, it's actually nice this time of year. Rare, gosh, but I enjoy it. And I'm not really working out because I got bad joints, so I'm getting up, going for a walk, and I'm listening to podcasts. If that's you, every episode of The Wise Money Show is on podcast wherever you listen. Just search The Wise Money Show on podcast, subscribe to it, and rate it, please. That really helps us, even if you don't really like the show or have some feedback, rate the show and give us that feedback. We appreciate it. All right, we're into questions from fans of the show. If you have a question about anything we were talking about, your investment strategy, your investment approach, maybe you are a little more emotional, maybe you did try to make some changes, or your system tried to make some changes, wasn't quite great, contact your CFP. And if you'd like to speak to one of our great CFPs on our team, just give us a call. Reach out to us. You can find us online, korhorn.com. That's Korhorn with a K, or at wisemoneyshow.com. But Jim reached out on the website, Jim64 from Edwardsburg, Michigan. The environment in my company has become more stressful in the past year due to everything that's going on. Yeah, that is everyone. I'm close to being able to retire, but I'd like to actually work 2 more years until I get my full Social Security. How do you plan for retirement when the timing's out of control? You don't have control over this.
Yeah, my heart certainly goes out to Jim. It almost reminds me, I was meeting with a client who's 25, 30 years younger than Jim earlier this week. And he was saying some of the same kind of uncertainty, talking about the stressful environment. He said there's significant uncertainty on whether or not he's going to have a job in the next 2 months or so. Mm-hmm. And so he wanted to know, well, what kind of action should they be taking? And we started looking at their reserves, what kind of cash they have on hand to be able to weather some sort of storm or to get through a period of no income coming in. And the same principle applies if you're coming into retirement or you're at risk of losing a job in the short term. It really boils down to, are you building up the right amount of cash? And that should be part of your game plan as you're trying to land the plane or kind of come into retirement. This is a time for you to make sure that you've got enough cash to live for an extended period of time, 2, maybe 3 years, because you don't know what the market's going to throw at you.
But not the market, just your world, your reality, your boss, right? And I'm like wanting to, do a Tiger Woods fist pump here as I hear you, because so we don't give direct advice on the radio. You've got to look at all 6 areas of your financial life, synthesize it together, and figure out, well, that of these great options, of these good options, here's the great one. But what stood out to me, Josh, is yes, building cash, because Jim says he wants to wait to draw Social Security until his full retirement age. Well, doesn't mean if you're let go early, doesn't mean that you have to draw your Social Security early. You could come up with a contingency plan right now to figure out, well, what's the pivot? What's the strategy so that I can continue to delay my Social Security without hemorrhaging my nest egg? And building up a little bit of cash, being more conservative with cash for as long as you've got your income might be that very, very solution.
You could take that too far, though, as well. And think, hey, I'm close to retirement, I should be all in cash, or I should be really conservative with my investments. But the reality is, Jim, even if you retire tomorrow against your will, and the paycheck stops and you delay, you postpone when you're going to start drawing Social Security, you're going to need some resources to live off of to cover that gap while you're waiting for Social Security to begin. But there's a bunch of money that you're going to need to be using and spending 20 years from now. And that money still has a long time horizon. It still needs to stay growth oriented. Don't be abandoning all stock market type exposure or all of your mutual fund exposure just because there's uncertainty in the short term.
Yeah, Jim, there are a couple ideas that I want to share with you. One idea is that the last year that you work is likely the most powerful financial year of your lifetime. And that's almost universally true. So no matter who you are, no matter what you're doing, the last year, or you could also say the last years that you work are the most financially powerful, because that means, so Jim, you're 64. If you worked 2 more years, that's 2 more years that you haven't taken money out of your investments. That's 2 more years that you've saved into your retirement plan. That's 2 more years. Maybe you got rid of your car payments. Maybe you finished paying off your mortgage. Maybe there's a number of different things, different possibilities that you can do in those last years. But I love Jim's question because it is profitable for you if you are not Jim and you're not yet 64. Hear what's in Jim's voice. Jim's saying, hey, listen, these things are kind of out of my control. Yeah. The company can make a decision, and we've seen it. We've seen these types of things. Hey, on Thursday, I had the best review of my career, and on Monday, they let me go.
Yeah.
So things, and I'm not a fearmonger, but I would say, hey, make sure you know what's going on. One thing that we do here at Korhorn Financial Group is we do something called case class, where we bring a client situation in. Typically, it's a new client to the firm, and the certified financial planners and the insurance agents and the CPAs get together and solve to figure it out. And we were working on one this week. It was just fabulous because this person, almost on accident, had tax diversification. So this person had money that's never been taxed that they had saved into their retirement plans. This person had Roth IRA dollars, and this person had non-qualified dollars. So all of a sudden, the options for this person are fantastic, and the really, it's just us saying, hey, you can do this any way you want to do it. Here's what we would see as good, better, and best. I'm surprised when people pick good. I'm sometimes surprised when people pick best.
Yeah. You've just given us a gift there. I love that you described the wins that you encounter as a financial advisor. You get to peer into people's financial lives and see what's working out for them. And you described it almost by accident. Probably along the way, as as this particular client is deciding where to save money, where to invest. They're just doing it in response to the changing tax environment. And they get to retirement and they end up with some money in a Roth IRA. They get some money in a 401k or a traditional IRA. They may even have just some taxable mutual funds. But that accidental diversification is such a winning formula so often. I mean, I see it all the time as well. And you know, we need to get to the point where it's not by accident that you have these types of options available to you, so that you can do what we hope Jim can do, and that is have a game plan that will let you cover the gap between when you're done working and when you start drawing Social Security, so that you can maximize the Social Security benefits that you ultimately get without hurting yourself from an investment standpoint.
So I'm surprised that we're this far into the question without answering it. Because someone said something that got me on a tangent, and we've been going about cash and how you structure your investments. But the start of the answer for you, Jim, is listen. If you were hoping to retire in 2 years, then you've already sat down with your certified financial planner, and you've probably been doing this for a decade, and you've talked through the 5 retirement factors, and they've put all those factors and all the variables into a system, a retirement projection, retirement plan, and you know that, okay, by retiring 2 years from now, you're on track and you're ready, and that plan has a certain confidence ratio if you retire at 66 2 years from now. And now you need to go back to that certified financial planner and say, things at my company are unhealthy, and I could be let go at any time now. Could my plan still work if I retire 2 years earlier, like that guy Josh Gregory says? Everyone retires a couple of years before they thought. And so can you move that retirement age, which is the first factor, move it up to 64? Does the plan work or not? And if it doesn't work, what are the trade-offs? Mm-hmm. What do I need to do? I mean, that is the answer, right? And then the trade-offs come as you look at all 6 areas of your financial life. Well, does that mean it's an income problem? So you got to make some extra side income. You got to ask your company if they'll put you on contract or whatever. Or is it a spending problem where, nope, you said you were going to spend $6,000 a month. You can only spend $5,500 a month. So lots of different options, but that's the root of the answer.
Yeah, you're exactly right. You're describing, though, the ideal scenario. Someone that has a long-term relationship with a financial advisor. They're working the plan, they're adjusting the plan. When they get a curveball like what Jim is maybe anticipating, and retirement may be kind of pushed upon them earlier than they thought, you've already got the relationship established. But I want to talk to the person who is Jim and has never worked with an advisor, someone who may be facing a lot of uncertainty, and the game plan that you've kind of loosely had in your head is being thrown out the window right now because of economic circumstances, business environment, all of that. And I want to tell you, it's still appropriate for you to seek the advice of a financial advisor in this environment.
Yep.
I've literally worked with clients who come in and we get started the day before they retire.
Not the ideal
It's
time.
not ideal. However, you're still adjusting the plan into retirement as well. And so for Jim, really the story problem is the resources you've built up and the income streams that are available to you in retirement. How do you make it work?
Yeah, because you might go in, Jim, if you haven't met with a certified financial planner and done that ideal approach, you might go in and they might say, actually, you could be done right now. And so, yes, let's talk about the best way to optimize your Social Security, whether you're done now or you stay till 66. Okay, so that's Jim. Let me talk about Jane real quick. Because the other side of the scenario is I was supposed to retire in a year or in 2 years, but it feels unsafe. And I don't know if I want to go back when we reopen. And the same answer.
Unsafe from a health standpoint?
Exactly. Because
okay.
I at this age group, I'm in a higher risk and so on. And we're not going to have time to completely unpack it, but the answer's still the same. It's really just an adjustment to that first factor and then seeing what the trade-offs are. Wouldn't you guys say?
I agree completely. I mean, you're basically just recalculating for a new scenario in this Jane scenario that you're describing. But the more things that you're willing to hold with an open hand and adjust on, the more powerful your financial plan becomes. It keeps you in control ultimately.
That's right. Well, great question, Jim. Thanks. I hope that was helpful. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, and myself, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.